Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Good afternoon. It's Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management company here in Valparaiso, Indiana, registered financial advisor and host of Money Matters with Greg. So excited to have you here. Welcome to Money Matters with Greg on 103.1 FM WVLP. We broadcast on Thursdays at 1 o'clock and then replayed on Saturdays at 1 o'clock as well. And then also anywhere you pod, you can find us Spotify, YouTube, you name it. Wherever you are, as far as wherever you pod, really. You find us on socials at Farrell Wealth, Farrall Wealth, and any of the socials, Instagram, LinkedIn, Facebook. We always mention this. This show is about money. We have conversations about money in regards to making money, investing money, saving money. We're going to go over two things today. One, need to talk about the Fed and what's going to happen tomorrow. And hopefully, we'll see. At least we can try to estimate as much as we can. I think it's really, really important that everyone knows what's going on with the Federal Reserve. Obviously, Chairman Powell's last meeting, that looks like for certain. And we'll see how that all goes as far as the press conference goes with that. I want to talk about that. And I also want to talk about really 10 rules that I can help you with as far as investing, some of the rules that are out there that you want to follow in regards to investing, putting money away and creating your wealth, growing your wealth, protecting your wealth, preserving your wealth, and then ultimately having your wealth distributed in your lifetime, distributed after death. So these are just those four quadrants we always talk about in the show in regards to the wealth management issues we see in our high net worth clients and high net worth families and the business owners we work with. Just because they have a bunch of numbers behind their net worth that you might not necessarily have, they have some of the same issues. So we try to always bring those issues to everyone so everybody can benefit and really be a fly on the wall on this show. Very always excited to acknowledge the fact that we're part of the WVLP family. Very excited always as well to be able to broadcast on Thursdays and Saturdays at 103.1 FM. So station identification for that. Also, highly recommend any of the conversations that we have here today. Recommend you consult with your financial advisors, your tax attorneys, and your accountants as well. Any attorneys, your team. We always talk about assembling a team and having a wealth management team that is your team and works for you. We are fiduciaries here at LPL, and we push that very much. That is our mission, is clients first. And you want to have a team that is client first and forward thinking for you and for your family's well-being to make sure that everything is invested on your premise and that everyone's working for you with your interest in hand. I want to get to the Federal Reserve here and what we're kind of seeing. I mean, we tapped, as far as the market goes, we tapped all-time highs again, kind of come off here. We've had big earnings week. So big week this week, a lot of earnings, a lot of different, the large cap companies that you're following, the tech companies you're following. Is a big tech week. This is a big earnings for quarter one. So you're seeing a lot of volatility in there. You're also seeing volatility back to the conversations about oil. So goes oil, so goes the market right now. And oil right now has retraced to go back up. It has definitely rallied in the last few days. That is the focus of what we've been watching as far as what happened last Friday. These steady advances off of these Friday lows that actually happened here, really putting pressure on treasury yields and a number of things that are just, we're watching. There was a really bad report with OpenAI as far as their revenues. That hit the market. But for the most part, we're kind of muddling, trying to figure out the news that's going on right now with rallies last week. And then ultimately, we've been down today. It's a lot of news to figure out. I mean, that's really what when I say muddle, I really mean it. We rallied here. Now what? is kind of the conversation. And now what leads into the FOMC preview? Look, it's not often that the Fed takes a back burner for investors, but it's really been the case here in the last few weeks because oil volatility, geopolitics, geopolitical issues certainly have dominated the narrative. Now, this may change with tomorrow. So Wednesday's FOMC meeting isn't really dramatic from a rate of decision, as virtually no one expects a rate cut. But it is important because, and I want to shed some light on this into whether the Fed still thinks it'll cut rates at all in 2026, as they alluded to in the last few meetings. And this may matter to markets more than you think as we move on. Now, it's true that Fed fund futures are only pricing in a 30% chance at a rate cut by the year end. But the forecast really largely is tied to the price of oil and oil drops on a U.S.-Iran ceasefire. Then we're going to see inflation anxiety sort of recede, expectations for rate cuts shoot higher, easily over 50%. And the point here is that even though the Fed fund futures don't have a rate cut in 2020-26 priced in, the reality is the markets still expect the next move by the Fed to be a cut that was really reinforced by the Fed dots that were back in March. And this really showed that Fed expects to cut rates by year end. The bottom line on that is really the vast majority of investors do expect a Fed rate cut that will sort of make this meeting positive or negative for stocks. And that's really why we're watching, is like trying to figure out where this is going to affect the market. So Chairman Powell tomorrow will reinforce that sort of the expectation for an eventual rate cut, or he could push back on it and cite sort of rising inflation pressures and look at the meeting as really no dots overall. And really looking at the statement is really, really key here. So looking at the statement, two areas of focus from the last meeting are the balance of risk in paragraph 2 and the forward guidance in paragraph 3. Now, currently, both of those imply future cuts. On the balance of risk, the Fed refers to itself in a statement as this quote unquote attentive to both sides of risk, which whatever. But thanks for that, meaning it is as focused on supporting really the growth as it is limited inflation. Okay, on forward guidance, the Fed statement refers to extent and timing of future cuts, in air quotes. And if you're watching this on YouTube, you're obviously getting air quotes. But if you're listening to this podcast, I'll just do the air quotes here. And this tells us that thinking of the Fed it's sort of when they cut rates next to how much, not if the Fed cuts rates. So it's going to come down to a follow-up on those two paragraphs, right? So paragraph 2 and guidance on paragraph 3. This is Powell's last press conference. So he'll be asked about the last two meetings, whether the rate hike was considered, and his responses are going to be important because does he go out guns blazing and rattle the markets? And back in January, he stated that no Fed officials had a rate hike as a base case because there's been whispers of a rate hike versus a rate cut. Now, in March, he mentioned that the, again, quote unquote, air quotes, vast majority of Fed officials didn't have rate hikes as a base case. Vast majority means somebody's certainly for rate hikes. Who might that be? Again, that's a dot plot type conversation. But point being, there are a few more Fed officials that appear to be thinking about rate hikes. And if that continues, markets will notice for sure, and it's not going to be in a good way. So what's expected? Here you go. No change to rates. No material changes to the statement. Powell repeats, quote unquote, vast majority of Fed officials aren't considered rate hikes, and we take our ball on our bat and go home. No mas, thank you very much. Markets expect the Fed to keep it consistent in 2026. Definitely markets consider a wait and see approach to spiking oil prices and the war. And as such, they really won't make a substantial change in the statement and then not do anything to really imply rate cuts are off the table. We'll see. So likely market reaction with that statement is a slight relief rally. There is some concern that the Fed could get a bit more hawkish in the tone in response to the high oil prices and inflated inflation metrics. So, status quo decision should cause a slight relief rally, but nothing substantial overall. Now, what happens if it's hawkish? Hawkish if the statement is altered to either tilt the balance of risk towards inflation and or change forward guidance to imply the Fed is officially on hold, and Powell states most or many of the Fed officials aren't considering rate hikes, meaning the number is shrinking. So these changes could see the Fed really officially guide to no rates in 2026, which would be a surprise. They really could do that by stating inflation has bigger risks, altering forward guidance, future changes, really to the Fed's funds rate won't be happening, or really by Powell implying that the idea of rate hikes is gaining traction in the Fed in response to higher oil and inflation. Likely reaction to that and the market reaction, a solid drop. Any of these changes could imply that the Fed is on top or on hold for the foreseeable future of rate hikes, and definitely something to worry about. So that would remove a bullish tailwind to the market that we've had here recently. April's been really good, knock on wood. We'll see what happens. So see if Powell can mess it up. Honestly, I'm really anticipating him to make us nervous. And I'm hoping he does the classy thing and just walks out the door and rides into the sunset, because it'd be nice to have some sort of validity here and security, the fact that we're not in Fed speak minds, which is super frustrating, because the market's following the Fed, and what the Fed says, it's usually really volatile. So if they do say, this hawkish tone because of inflation, we'd expect cyclical sectors to lead to the markets lower, while defensive sectors depends. Utility staples, healthcare typically outperform. And we just expect everything to be lower depending on what he says. So if more Feds favor a rate cut, the best chance for that surprise is really through his press conference. You're not going to get it from anywhere else. It would be a modest rally as well. I don't really see that happening, because it seems like they're leaning towards no Moss or rate hikes. And right now, let's figure this stuff out. And we need time to be able to figure out the war and oil and a number of things. And the market's trying to do that as much as it can. We'll see super important stuff right there in regards to the markets and the Fed, and then just the overall thought process with what we're seeing, and we'll see how the market reacts. Sure. So hope that was helpful and sort of updating you on what's going on with the Fed and what's happening this week. We are broadcasting here on Money Matters with Greg. The show's Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm. We are financial advisors and fiduciaries here, helping clients of high net worth individuals and families with their overall investments, their debt structures, their stock options, their estate plans, a number of different things that we talk about. And we try to bring those conversations to you to help you out in regards to your wealth growing, creating, protecting, preserving your wealth over time. So hopefully this was helpful to kind of like figure out what's going on with the Fed. I also wanted to be able to get into really sort of a David Letterman, and many of you won't even remember who he is in this audience, but a very popular late night host of the David Letterman show in New York. He is a Ball State graduate, and proud Ball State graduate that has donated millions of dollars to the David Letterman communications department there. So very thankful for him for that. He had a top 10 that would always drop. So 10 reasons why, 10 reasons to do, 10 reasons to think about. Basically going to mimic that a little bit and just talk about some of the things that that can be help you with your wealth, and kind of rattle off some things. We can get into these things a little bit later in more detail. If you have any questions about these, greg@farrellwealth.com, please email me. I'd love to hear from you. If you have any ideas about future topics you'd like to be able to talk about on the show, or have our guests on the show, of course, we'd love to have you as well. So one thing just off the top of my head here, as far as the 10 I've got an organized list here, but this was off the top of my head initially, and then sort of has been formulated into these rules that are part of your life. And if you have a question on it, obviously you can AI it, Google it, whatever. But one of them is, the first of it is a 1% housing rule. So budgeting 1% of your house value every year for maintenance, repairs, and surprises. Now, obviously, if you're renting, you could do the same thing in regards to this for saving for a home. But basically, on a $500,000 home, if you have $5,000 set aside annually, it's about $417 a month. This really keeps you from getting crushed on that new roof, the HVAC failure, the plumbing nightmare that most homeowners dramatically underestimate. You look, I live in the Midwest. We live in the Midwest. We've been having horrible storms. We've had water, we've had rain, we've had hail. It's been brutal. Our March sucked. It's one of the worst Marches I've ever been around as far as just what's going on here in the spring. But whatever, it's part of the gig. But you do have, and when you come out of winter, you have issues, and there's definitely stuff that you're like, I didn't see that coming. So setting aside 1% of your home's value every year for maintenance is something to seriously consider and to work on. The 28% mortgage rule is the next rule. No, so never let your housing expense or payment, mortgage plus taxes plus insurance plus your HOA, exceed 20% of your gross monthly income. You know those numbers. I don't. But you can certainly put pen to paper or calculator. But banks will be really happy to approve you for more. Don't let them. Staying under this keeps your budget, really, it gives you breathing room and protects you if rates rise or income dips or something happens to you in your job, to you and your family, to you and your spouse, whatever it might be. The 28% mortgage rule is a really good rule. Mortgage plus taxes, plus insurance, plus HOA, not over 28%. Rule of 1,000. To generate $1,000 of monthly passive income at a conservative rate of 4% yield, you need $300,000 invested. And I'll scale that up to $2,000 a month. You need $600,000 invested. If you want $4,000 a month, that's $1.2 million invested. And people talk to me all the time and ask me, like, what's my number? What is needed in order for me to retire? With any good financial advisor and planner, the first question they're going to ask you is cash flow. Like, what are you spending? So if you're not spending for more than $4,000 a month, then you're going to need $1.2 million to be able to generate that passive income and kick off that yield, so you don't dip into the $1.2 million as far as principal. So this makes retirement income feel real, and intangible, and sort of this abstract number that's out there. Okay, so for every $1,000 a month in passive income, you want to consider the 4% yield, which you can get out there right now. You don't have to get too risky to get the 4% yield. Treasuries are yielding 4.2 right now. So you need $300,000 invested to get 1,000. You need 2,000. You need 600,000 for 2,000, and you need $1.2 million for $4,000 a month. Okay, so that's the rule of 1,000. Next one coming in at, let's see, where were we? Number 7. 100 minus your age rule. Now, this is going to be one that I'm going to disagree with. I want to give it to you for facts, straight up. So you subtract your age from 100, or 110 or 120 if you're more aggressive. So that's an easy way to do it, to get your stock allocation percentage. So if you're age 30, then it would be 70 to 90% stocks. You age 60, you're 40 to 60% stocks. So it's subtract your age minus 100. Now, it's simple. It's an automatic way to reduce risk as you age without overthinking portfolio design and how do I do this and how do I do that? Where does this go? So very, very easy. I'm going to disagree the fact that it's 60, that you need to get into 40% of equities and 60% of income. But look, everybody's different. We don't talk people into a time horizon. We don't talk people into their risk tolerance. We have conversations with people, and look, if I was in the business of judging, I'd be out of business. So it is very important to have equity exposure, because just because you retire doesn't mean you die. You have expenses, you have inflation, you have things you have to compete against. So I'm not necessarily a fan of saying, look, I got to tone things down so much that you absolutely shut things down. I think it can be warranted and justified to have a better or even a higher stock allocation as you grow and grow older. You still have time on your side, even though you might not necessarily think so. you're not going to lose all your money tomorrow because you still have other assets, or you still have an asset allocation that is somewhere between 50-60% conservative, wherever that might lie. But 100 minus your age rule is a pretty good rule to just, if you want to be more aggressive, age yourself at 120 minus your age. Rule 72, very, very popular. Divide 72 by your expected rate of return to estimate the years that it's going to take to double your money. So the rule of 72 is doubling your money. So think about that. 8% return is going to take 9 years. 10% return is going to take 7.2 years. 12% return is going to take 6 years. So if you have 100 grand, in order to get 200 grand, at 12%, it's going to take 6 years to double it. So this rule makes the power of compounding visual and exciting, and you see it, and it turns saving into a race you can actually see winning. So put that money away, let the power of compounding do its job, and then double your money. And then the $200,000 becomes 400, the 400 becomes 800, the 800 becomes 1.6. So these are things that just keep on rolling. Like, don't be discouraged that you only have 5 grand to put away. It's okay. 5's going to turn into 10, 10's going to go to 20, 20's going to go to 30, or 20's going to go to 40. So these things really, really matter as far as time in the market, not timing the market. Get it in there and make sure you've got a good asset allocation that's quality, that's going to get you on a path to the rule of 72. Number 5, the 10 times rule. Aim for 10 times your annual salary saved by age 60 to 67 for a comfortable retirement. Example of that is an $80,000 salary. You want an $800,000 portfolio, or $800,000 investable assets that can kick off income for you down the line, wherever that might be. Now, this is clear, and it's a motivating target that really begins this vague, like, save more advice. Okay. So 10 times your annual salary saved by ages 60 to 67. You're going to have Social Security, you're going to have other income mentions and coming in here. But basically, knowing that the 10 times rule is really, really important. If you want to, that's what you're going to need. Now, back to this. What's your cash flow? If you're spending more than the $880,000 salary that's going to kick off on an $800,000 portfolio, like, you're going to put too much pressure on the portfolio based on your cash flow. So if you know you're going to be spending more in retirement, and you know you want a lavish, more involved travel expenses, fishing, golfing, membership, all these other things in retirement, you know that your cash flow is going to be higher than others. So you might need to save more money. And that's just your own personal preference. The 4% rule, number 4, in retirement, we know this, we hear this all the time. You can safely withdraw 4% of your portfolio in year 1 and then adjust for inflation year after year. But historically, it's lasted like over the last 30 plus years in almost every market scenario that's out there. It's really the gold standard for turning big number into substantial income without running out of money too soon. I always like to relate it to a college endowment or a nonprofit endowment, that they know they cannot spend the money above and beyond their principal. In order to stay in business, they need the principal for creditors, for loans, for growth, or whatever it might be, and they don't want to spend more than the actual the core. So they're able to kick off 4%. They take 4%, use it for expenses, and then they never lose the principal. So if they want to stay in business, the same rule goes for you. So if you have $1 million and you don't spend more than the 4%, then you know you're going to have $40,000 coming in every single year in income. You can guarantee that, and you're not going to lose the $1 million. He's going to have a chance for growth as well. Okay. Last 3 coming up here, the 50, 30, 20 rule. Now, this is the simplest budget on earth. Okay. But let's just make it simple. 50% needs, right? What do you need? I need housing, food, transport, minimum debt. Okay. Those are my needs. Let's see if we can get rid of the minimum debt. Housing, food, transport, right? 30% are wants. What do I want? I want to go out. I want to eat good food. I want to be entertained. I want to have hobbies. I want to have a life. 20% savings, debt payoff, retirement, emergency fund, extra payments to yourself, paying yourself, which we'll get to in a minute. It works for almost everyone and gives you the guardrails without really tracking every coffee and all this other stuff like you see on TikTok and everywhere else, as far as Instagram or wherever you go on socials. Like if I don't drink that coffee, well, you know what? Maybe I want to budget that coffee. That's important to me. Right. So figure out some other way where you might be able to knock something else out to be able to afford that coffee and not think about it. This is a great, easy way to do it. 50% needs, 30% wants, 20% savings, 50, 30, 20 rule. Okay. The 3-month emergency rule. So 3 to 6 month emergency rule. This is paramount. Keep 3 to 6 months of essential living expenses in cash in a very safe liquid account, high yield savings account, whatever you want to do, wherever you want to go. Now, this recommend, I've been self-employed since I was 23. I'd probably recommend more if you're self-employed because you have variable incomes all the time. You support a family and you don't have that set W-2 cash coming in every single time. So sometimes you're going to need to dip and grab into the savings account because things in your income moved. This is your life doesn't go as planned insurance policy, sleep at money at night account. Prevents you from sort of derailing your entire financial plan with one bad event. Furnace goes out. There's a flood in your apartment and you suddenly have a, $10,000 replacement fee or whatever. You need to replace all your furniture and, it's tragic, right? But it costs money. You have to move. You get a new job. All these other things where this is where like, I need to kind of dip in. I lose my job. You need 3 to 6 months of emergency rule. That's kind of a nice rule to have. Okay. And then finally, on our David Letterman top 10 is number 1, pay yourself first. If I could have followed this rule back when I was 23, I can't even imagine the amount of money I would have. So save and invest first. And this is basically before bills, before fun, before everything else. You make sure you're putting money away into your name, into the buckets of money that you designed and you developed to make sure you pay yourself first. Pay yourself first, and then everybody gets theirs. Now, you really need to treat your future self as the most important creditor you have. Automate transfers the day you get paid. This is a single mindset shift that really separates people who build wealth from people who just stay busy and have a job that runs their life. Everything else on this list becomes 10 times easier once this is non-negotiable. Pay yourself first. Now, these rules work really best together. Pay yourself first powers the savings rate that feeds the 50-30-20 rule and the 10 times target. The rule of 72 shows you why starting early is really magic. The emergency fund and housing rules protect the whole system and probably will save your relationship, your marriage, and a number of other things. The emergency fund is great because there's like less stress, which is the number one issue in married couples and any couples really is financial situations for sure. That's my top 10. Thank you, David Ledman, for your honoring you today, really in your top 10 list that you've done for years. The show's Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. It's a wealth management firm here in Valparaiso, Indiana, serving clients all over the nation. I think we're literally in half the United States now, which is wonderful. Thank you to our clients and our friends that are a part of our group. And thank you for our listeners for being here. WVLP 103.1 FM. Here locally, 103.1 FM. You can find them at wvlp.org. I highly recommend you checking them out and all the different shows that are out there that are fantastic. You can also listen to us on TuneIn Radio and then find us on YouTube and anywhere you pod, Spotify, Apple, you name it. Thanks for being here today. Looking forward to another great week. Hopefully our April improves in regards to the weather here in the Midwest. I want to congratulate our Chicago Bears on a great draft. Looking forward to the future here. And I also want to congratulate my favorite Indiana University national champions who had 8 going in the draft. Very excited to watch those guys in the future as well. Nice little sports plug at the end. In the meantime, guys, have a great week, and looking forward to you guys reaching out and let me know how things are going. Okay? Talk soon. Thanks again. See you. Bye.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.